Welcome back, my friends. The news today is that Medical Properties Trust has slashed Dividend in a cash-preserving move. Financial shakeup. Dividend cut in half. Stock downgraded. This comes amid increasing distress practically everywhere in the commercial real estate business. Big US banks are reportedly trying to dump commercial real estate loans. But buyers are scarce as pressures mount for property markets. What does it mean for real estate investment trusts? What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. And, before we continue, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions. Doctors, including any type of specialty. Nurses, and that includes all grades of nurses. Lawyers, regardless of area of legal focus. Teachers and professors, from kindergarten through graduate school. As well as any kind of job that requires a government license or certification. And ProWorld.net also includes short-term gig-type jobs as well. So, be sure to check out ProWorldNet.com if you are looking for a job or an employee. Medical Properties Trust Incorporated NYSE, MPW, has announced the adoption of an updated capital allocation strategy, with the aim of bolstering its balance sheet, reducing its cost of capital, and positioning the company for long-term value creation for its shareholders. The revised strategy places a priority on expediting debt reduction while also maintaining a focus on returning significant cash to shareholders. With this refreshed capital allocation framework, we believe MPT will be even better positioned to deliver long-term value through our profitable investments in hospital real estate, said Edward K. Aldag Jr., Chairman, President, and CEO. As we made clear during our recent quarterly earnings update, our focus is squarely on reducing leverage and improving our long-term cost of debt and equity capital. Our board is confident these decisive steps will facilitate achievement of our target leverage ratios and create significant strategic and financial flexibility. Over the past 18 months, MPT has undertaken a series of transactions that have impacted adjusted funds from operations, AFFO, including some pretty bold moves. Partnering with Macquarie Asset Management for 8 Massachusetts hospitals. Repurchasing 14 facilities from Prime Healthcare. And selling 7 Australian hospitals. The company has also announced additional transactions slated to close in the latter half of 2023. These transactions include another couple of bold moves. The sale of its Connecticut hospitals to Yale New Haven Health for approximately $355 million. And the remaining Australian portfolio for about $300 million. While these transactions have been profitable, they have led to a reduction in MPT's leased assets by approximately $2.5 billion. Moreover, MPT has announced today it will declare a quarterly cash dividend of 15 cents per diluted share. This dividend will be paid on October 12 to shareholders of record as of September 14. CEO Edward Aldag outlined ambitions to trim down debts and better position the company financially. This significant dividend cut, dropping to 15 cents from a previous 29 cents, aligns with their current strategic adjustments and financial targets, including plans for future investments and a closer look at operational costs. Medical Properties Trust Incorporated, MPT, is a Birmingham, Alabama-based company that focuses on acquiring and leasing healthcare-related properties, particularly acute care hospitals. The company was founded in 2003 by Edward K. Aldag Jr., a seasoned real estate executive. MPT was created with the intention of capitalizing on the growing demand for medical facilities and healthcare services due to an aging population and advancements in medical technology. For those of you not familiar with Medical Properties Trust, MPT, here's a general background of its history. MPT is founded by Edward K. Aldag Jr. The company initially raises capital and begins acquiring healthcare-related properties. MPT experiences steady growth during this period, acquiring a number of medical facilities, including hospitals and rehabilitation centers. The company focuses on forming partnerships with leading healthcare providers and operators. MPT's portfolio continues to expand, and it gains recognition as a leading player in the healthcare real estate sector. The company raises additional capital through various means, including public offerings and private placements. MPT's growth trajectory continues, and it becomes one of the largest owners of hospital real estate in the United States. The company's business model involves acquiring properties and then leasing them back to healthcare operators under long-term agreements, generating a stable income stream. By this point, MPT's portfolio includes a diverse range of healthcare properties, such as acute care hospitals, rehabilitation hospitals, and outpatient facilities. The company benefits from the essential nature of healthcare services, which tend to be resilient even in times of economic uncertainty. Throughout its history, MPT's business model has been to acquire healthcare properties and enter into long-term triple net lease agreements with established healthcare operators. These agreements typically require the lessees to cover property-related expenses such as maintenance, insurance, and property taxes, which provides MPT with a predictable and stable income stream. It's important to note that the healthcare industry and real estate market are subject to various changes and challenges over time, which can impact the performance and growth of companies like Medical Properties Trust. For the most current and accurate information about MPT's history beyond September 2021, I recommend consulting reliable financial news sources, official company reports, and other relevant resources. A real estate investment trust, REIT, is a type of company that primarily owns, operates, or finances income-generating real estate properties. REITs were established as a way for individual investors to invest in real estate without having to directly own, manage, or finance properties themselves. They offer a way for investors to access the potential benefits of real estate ownership, such as rental income and property appreciation, while enjoying the liquidity and diversification benefits of publicly traded securities. And, if you are not familiar with real estate investment trusts, they have some key characteristics. REITs generate income primarily from renting, leasing, or operating real estate properties. The income generated by these properties is typically distributed to shareholders in the form of dividends. REITs are structured as corporations or trusts. They are publicly traded on stock exchanges, which means investors can buy and sell shares in REITs just like they would with stocks. Many REITs own a diverse portfolio of properties across different sectors of the real estate market. Multifamily residential, commercial office buildings, shopping malls, industrial warehouses, distribution centers, and healthcare properties, such as hospitals and medical centers. To qualify for special tax treatment, REITs are required to distribute at least 90% of their taxable income to shareholders in the form of dividends. This can make REITs attractive to income-oriented investors seeking regular cash flow. REITs are granted certain tax advantages. They don't pay federal income taxes on the distributed earnings, as long as they adhere to the requirement of distributing the majority of their income to shareholders. REITs are managed by professionals who oversee property acquisitions, leasing, management, and strategic decisions. This allows individual investors to benefit from the expertise of experienced real estate professionals. Because REIT shares are publicly traded on stock exchanges, investors can easily buy and sell them, providing a level of liquidity that direct ownership of real estate often lacks. REITs are subject to regulatory oversight and are required to provide regular financial reporting, making their operations and performance transparent to investors. REITs provide a way for investors with varying levels of capital to participate in the real estate market without the substantial upfront costs associated with purchasing properties outright. REITs can be categorized into different types based on their investment focus and the types of properties. Big banks want to sell some of their commercial real estate loans, but buyers are proving scarce as troubles pile up in the sector, according to a report out from Bloomberg this week. JP Morgan, Goldman Sachs, Capital One, and M&T Bank. Banks could be willing to sell property loans at a discount as troubles mount in the sector, but some are hesitant to sell off commercial real estate debt at too low of a price, as that could reignite fears of banking troubles, sources added. As a result, many banks are choosing to hold onto the debt while they seek better offers. JP Morgan, for instance, has been looking to sell a $350 million loan backed by the HSBC Tower in Manhattan, Bloomberg reported, with the bank offering potential buyers ultra-low interest financing, sources said. Capital One has also been trying to dump its portfolio of office debt based in New York, sources said, with the company's chief financial officer stating last month that the bank is seeking to sell $900 million of office loans. Goldman Sachs has been looking to sell its loans on hotel and apartment buildings, sources added, while M&T Bank is looking to shed a hotel loan. Experts have been warning of trouble for the commercial real estate sector after the slew of banking failures in early 2023 sparked a rapid tightening in credit conditions on top of higher interest rates spurred by the Fed's rate hike campaign. That poses trouble for the commercial real estate industry in particular, as there's around $1.5 trillion in commercial real estate debt that's set to be refinanced over the next 3 years, much of which could run into trouble as rates stay elevated and property valuations decline. The risk of foreclosure has also spiked as late payments pile up on commercial real estate builders. That could crescendo into a full-blown commercial real estate crisis, some industry veterans have warned, with around $155 billion of commercial real estate debt at risk of default, according to a recent MSCI report. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.